What's up, guys? It's Lloyd and I'm back and I'm live, and today I'm going to be talking to you about inflation. What the heck is inflation? You're probably seeing it in the news every 5 minutes. If you're reading the financial news, you'll definitely be seeing it, but you're probably going to be seeing it everywhere. I mean, it's going to be the talk of money right now is all about inflation. So what is this inflation thing? What the heck is inflation? What's up, Tom? Thanks for jumping on live. I'm here on Instagram. This will be streamed to YouTube and other places like that. My actual Facebook actually has been deactivated today for some reason, so hopefully that gets back online soon. So this will be on Insta. I'll say this on my IGTV and YouTube and some other places like LinkedIn. But thanks for jumping on. You got any questions as we go? Feel free to pop them in the comment section. Share the live, tag your friends in it. Let's talk about inflation. It's really simple. Ready? Inflation means expand. Inflation means go up. Inflation, what's up, Wes? Thanks for jumping on live, man. Inflation means prices inflate. That's what it really means. People think that it's all about currency devaluation, but it's actually about when money is cheap or when there's a lot of money in the economy, spending goes up. That's what really happens. Spending goes up. And when spending goes up, it means prices start to go up, right? Slowly. It's called price inflation. Okay. So usually inflation runs at about, lately it's been like 1% a year, but it's normally around between 2.5%, 3% a year, right, in a strong economy. So that's why, like, when you used to go to the movies, it was like my mom used to go to the movies, and she said it was 20 cents to go and see a movie, but now it's like $20. So inflation has actually increased the price of everything, which is normal. Okay, here's the thing: the reason why inflation has been talked about so much at the moment is because there's so much loose money out there. There's so much money. Interest rates are so low, okay, that debt is cheap, which means people are borrowing a lot of money, okay? And the Federal Reserve is actually buying a lot of bonds and flooding the market with money. And because debt's cheap and people are buying so many things, inflation is going up, right? Because there's so much purchasing, so much spending going on. And what that means is that prices are going to start rising. In fact, recently in the US, inflation was ticked up at 4%. It's rising fast now. What's up, Carlos? Thanks for jumping on live. What's up? Hi. So if you've got any questions about inflation, pop them in the comments there on Instagram. But why is inflation important? Here's why. When inflation goes up, so there's two things that cause that. Number one is spending. So when money's cheap, people borrow more and they spend more. It means prices go up. It means we have inflation. The other thing that can happen is it can be caused by a lot of excess money supply, which actually means that the value of the currency falls because there's an oversupply of that currency. Okay, so if that's happening, plus spending's happening at the same time, we see advanced inflation. Now, what's the problem with inflation? Here's the issue. If there's too much inflation and prices are rising too quickly, or there's too much money supply, or both at the same time, and taxes are low, and it's just the economy is on fire, it can actually increase prices too fast. And all of a sudden, like what happened in Germany before World War II is you used to have to take I think it was Deutschmarks. I forget what the German currency was back then, but they would have to take wheelbarrows of the local currency down to the shop to buy a loaf of bread. And the same thing happened, I think it was in Zimbabwe, but it means that you're going to have to, a bottle of milk or a loaf of bread is going to be $100. If inflation gets too much, if prices rise too quickly, that's what happens. And the value of your money falls. It's not that there's always necessarily too much money being printed. It just means that prices are running so fast as well. And that means your dollar bill will buy less. That's why you go to the shops now and it's like $2 for a red frog. And it used to be like 5 cents when I was younger. So here's what we don't want to have. We don't want inflation to go too high because we don't want the value of our currencies across the world to fall. Okay. And so here's what happens. This is where the issue lies. If inflation goes too high, then there's only two things the government can really do or the Reserve Bank or whoever it might be, can actually do to actually stop that happening. One is can increase taxes, okay? Because if you increase taxes, then there's less money actually in the hands of people to actually spend. There's less discretionary saving to actually spend. And that's what's happening a little bit in the US at the moment. But the other thing is the key tool that the Reserve Bank uses to actually curb inflation, to reel it in, is they increase interest rates. And that's what happened in the 70s when there was hyperinflation happening. when inflation was so high, they had to increase interest rates to 17% to actually break its back and bring it back down again. Now, here's the thing. If inflation ticks up too quickly, right, which they're a bit afraid of, then it means interest rates will have to rise rapidly to actually curb the inflation. Now, if that happens, then those who have a large mortgage, those who have margin on shares, borrowing on margin to buy shares, have any sort of debt, they are going to get a rude shock when all of the cost of debt goes up. And even countries are going to get a rude shock. They're like, oh, we have all this debt. Now rates are going up to curb inflation. Uh-oh, we're holding all this debt. We need to get rid of it. So they start offloading assets. And that's when you see the business cycle peak and come back, right? So Wes is saying that with more money being printed, we're heading for another. Not necessarily. The money printing is not that bad if the Federal Reserve is actually buying the bonds back. They have to print the money to even it out. The issue is that interest rates are. The issue is if inflation goes up, which it will certainly if there's more money supply, definitely. But if there's more spending, which is the real issue, I think at the moment, there's so much spending going on that if it curbs up too much and they've got to increase interest rates quickly, that's what can lead to what Wes said, it'll be a recession, a correction, a big one. Asset prices will be flipped on their head. So shares will go down in value, property will go down in value. People are trying to get rid of their mortgages, rid of their margin calls, rid of their borrowing, basically. And the world will start to delever and start to get rid of its debt. And if that happens, then spending falls. And if spending falls, it means the economy cools and inflation ticks down. And then inflation comes back down again. And inflation goes down, they go, okay, we've saved the world. And then we have to make sure that it slowly goes back up again. Because you want to have inflation. Inflation at 2%, 3% is good. And it's good for all of us. But the reason I'm explaining this is because a lot of people don't understand what inflation is. It's a real simple supply and demand economics of money. And the real risk of it, why we don't want too much of it, is because interest rates will have to go up too quickly. And if that happens, a lot of people are going to be sat there holding big mortgages, and they're going to be really under the pump. There's going to be blood in the streets. But it's not to say it's going to happen. If interest rates go up slowly and we can curb inflation, that'll be great. And I think that's, hopefully that's what's going to happen. So we'll see. But, interesting times we live in. So if, personally for me, I wouldn't be running out and getting into a lot of debt at the moment. And I certainly wouldn't be investing in tech stocks, because what's happening at the moment with inflation as it goes up, and if rates go up to curb the inflation, it means that stocks, as I said before, stocks and property go down in value because the future cash flows are discounted back at a higher interest rate. Now, for those of you who don't understand net present value of money and all that stuff, I get it. But it means that the value of the asset based on its future cash flows is lower today because the interest rate is a lot higher. Okay, so that means that tech stocks and the NASDAQ and Cathie Wood's ARK fund, they're in for a big shock. And Tesla's going to get crushed. I mean, it's already dropped to $100 a share. I mean, it's already happening. You can see it because there's massive inflation ticked up in the US. So let's see what happens to stock prices. But I'm fairly certain tech stocks are going to get crushed and we're going to move back into cyclical. So if you want to take advantage of the inflation play in terms of stocks, you want to stick to, I think banks are good during rate rises because they make money from net interest margin spreads. Commodities like mining companies, obviously you can see they've been going well. Oil's quite good too. As well as if you want to store a value, people look to gold. I don't invest in gold at all because it doesn't produce anything. But there are some good cyclical businesses you can be part of. If not, buy an ETF, just be in the market, and invest in an ETF and just hold. And if the stock market gets corrected and falls by 20% when interest rates go up, don't be shocked by that because they're a little bit overvalued at the moment. It doesn't mean they're going to fall down to zero, so chill out. It means you should probably be buying more if it does fall. Okay, so just be aware you want to keep buying when it's down and down and down. And I dare say if inflation ticks up really high in the next year or two and rates follow it up, we're going to see a correction that's going to be interesting. It's going to create a lot of opportunity, especially if you want to buy a property, especially if you want to get into shares. I think it's going to create a great opportunity. But if you're already in them, delever your debt, get out of the debt as much as you can, but also don't sell your assets, because they're falling in value. It's a normal process of things. It's the normal business cycle. But that's how inflation actually affects asset prices and investing in your decisions, okay? So let's see what happens. I'll be interested to know. I'd love to come back and look at this. So if you enjoyed this, tag your friend in it. Hope it's answered some questions. I'll save it on my IGTV, and I'll see you on the next live.